Welcome to this video in the Insurance Terms Explained series. Today we're covering the very common insurance term, loss ratio. We have a choice of 5 possible definitions for this term. Which do you think is correct? Is it paid claims divided by premiums? Ultimate claims divided by premiums? Ultimate claims and expenses divided by premiums? Profit divided by premiums? Or years of loss divided by total years of operation? Let me give you a short while to consider your answer. Let's look at paid claims divided by premiums. Now this one could be defined in 2 different ways. Firstly, you could add up all the claims paid out by an insurer in a calendar year and then divide that by all the premiums written or received in the same calendar year. Hopefully you can immediately see that we're not comparing like things with like here. The claims paid out in a calendar year won't just relate to premiums written in that calendar year. Claim payments are often made a long time after the policy cover begins. So this ratio will be very confused and confounded by changes in mix and growth of book and individual large claims progressing through the course. So definitely not the right answer. A second better calculation would be to consider paid claims against the relevant premiums for those claims. So aggregating everything up by underwriting or accident year will give a consistent calculation. And this is one that is used, but it's always called the paid loss ratio. It will naturally miss future payments relating to open and unreported claims, so it will give a much lower figure than the true loss ratio calculation. Not quite right one to use, because people will be thinking of an ultimate position when all the claims are settled, not the current paid position when they talk about loss ratios. Let's go back to our 5 options. Which do you think is correct now? Is it years of loss divided by total years of operation? Frankly, no. Despite including loss in the calculation, this is not a standard metric calculated in insurance. It can actually be a little useful with people outside of insurance though. If you hear people talking about greedy insurers and how much money they make, and they usually are talking about personal lines insurers here, which is a highly competitive market, there's literally no excess profits, then you can quote how frequently such insurers write to a loss-making position. And they really do provide a great product with little margin extracted from their customers. But when you're working in the office, this is very much not the definition of a loss ratio. Let's go back to the 5 options. Changed your mind again? How about ultimate claims divided by premiums? Hopefully from what I've said to you, it's pretty clear that this is the right calculation. Take the ultimate position, which is obviously unknown, but can be calculated using actuarial techniques, and divide it by a consistent measure of premiums to derive the loss ratio. This is the standard definition which you should know and recognise at work. However, it's not the whole story, so let's go back to our 5 options. We've got 2 options left, and it's worth discussing them now. Firstly, ultimate claims and expenses divided by premiums. If we use consistent groupings of claims, expenses and premiums, then this is a valid insurance metric called the combined ratio, or sometimes the operating ratio. This brings in all the expenses related to underwriting those policies, be it broking or marketing, and all the expenses related to administering the policies and claims. So the combined ratio gives a truer picture of how much money is going out of the insurance company compared to how much has gone in. Much more of a measure of profitability than loss ratio alone, which misses a large chunk of the outgoings of an insurer. And now this is a standard term, and you should learn and know this one too. Just remember, it's not the loss ratio itself. So we've got 1 option left. Why don't we just take profit and divide it by premiums? You could see this as the combined ratio plus all the other profit items to give a true metric of profit. But this is not a standard insurance term for a few reasons. Firstly, profit is difficult to allocate to underwriting or accident year, and hence to get a consistent measure of premium to measure against that profit. Now, it would be good to bring in investment income into our view of profitability, as this can be a significant income for a writer of long-tail insurance. However, there are many items which go into profit which are highly variable, for example restructuring costs, that would make this a very volatile measure. If you did want to consider the total profit level, then the metric most used is the return on capital employed. This is a much better metric, as it can be compared to the cost of that capital, and avoids a bias towards risky long-tail business, which a pure view of profit might do. So hopefully you now know what a loss ratio is and how to calculate it. Thank you very much for watching. I hope you found this video informative and helpful. If so, please give it a like and consider subscribing to support this channel and encourage me to make more videos. Goodbye.